Usually when we talk about building an institutional portfolio, there are just certain unspoken rules, right?
Oh, absolutely.
Like you want predictability, you want established boardrooms, incredibly clear regulatory frameworks, and just assets that don't, keep you up at night sweating over a random tweet.
Right, the traditional finance checklist.
Exactly. But then you look at diversifying with digital assets, and for a lot of traditional allocators, the entire crypto space just feels less like a strategic investment and a lot more like a speculative casino.
Yeah. It is a completely different paradigm for anyone coming from TradFi. You are suddenly dealing with anonymous founders, constant regulatory ambiguity, and, decentralized networks that can essentially just split in two overnight.
Right, if the developers just get mad at each other?
Exactly. If the community disagrees on a software upgrade, boom, you have two networks.
It's enough to make any institutional risk officer just run for the hills. But so what if I told you there was a network governed by the likes of Google, Boeing, and IBM? A network that's, officially cleared by U.S. regulators, actively settling billions of real-world corporate transactions, and boasting tech that just fundamentally outpaces legacy blockchains.
You'd think that would be the undisputed crown jewel of an institutional portfolio.
You really would. But, here is the kicker. Its token price is currently sitting roughly 87% below its all-time high.
Which is just, it presents a fascinating and frankly quite confusing paradox for anyone analyzing the space right now, in July of 2026.
Right. So our mission today for this deep dive into the source material is to figure out if Hedera and its native token HBAR is actually a viable long-term asset for you to put in an institutional portfolio. Or, is it just a highly efficient corporate science experiment that will literally never translate into financial returns?
Yeah, that's the billion-dollar question.
Okay, let's unpack this. We are pulling from a massive stack of recent sources from July 2026. We've got deep dive technical assessments, plus market reports from CoinStats, Binance, KuCoin, and ET-Fatleys. And they're all just trying to make sense of this specific asset.
And my goal today is to help us cut through the overwhelming noise in these reports, We really need to examine the true relationship between Hedera's impressive enterprise adoption and its actual tokenomics.
Because they don't always match up.
Exactly. In this specific case, overwhelming network success does not automatically equal token price appreciation. And we have to understand the physical mechanics underneath that disconnect to really evaluate the investment.
Right. So to understand if HBR actually belongs in a serious portfolio, we first have to understand why major institutions are choosing it over legacy giants like Ethereum or Bitcoin in the first place.
Right.
And it starts with the somewhat mind-bending fact that Hedera isn't actually a blockchain.
Yeah, that always trips people up.
Right. It uses a technology called a directed acyclic graph, or a DAG, and relies on a specific consensus algorithm called Hashgraph.
And that underlying distinction is just paramount. A traditional blockchain, like Bitcoin, operates sort of like a single file line at a grocery store checkout counter.
Okay, I like that analogy.
Right, so transactions are bundled into blocks, and those blocks have to be processed one by one in a linear chain.
So it's slow.
Yeah, exactly. If the line gets too long, things slow to a crawl, and the cost of, jump to the front of the line skyrockets. Hashgraph, on the other hand, operates more like a crowded room where everyone is just rapidly gossiping with each other.
Yeah, the sources actually refer to it as the gossip about gossip protocol, which is a fantastic mental image. But how does gossiping actually create a secure financial ledger?
So every time nodes in this network exchange data, they attach a tiny timestamp. And this details exactly who they talked to, what they shared, and when they shared it. So they're sharing the history of how the information spread. And because of those timestamps, the network can mathematically reconstruct the exact chronological order of every single event.
Across the entire system?
Across the entire system, yeah, without ever needing to cram them into sequential blocks.
Wow.
So through this massive parallel processing, the network comfortably achieves over 10,000 transactions per second. And that's with a finality of just 3 to 5 seconds.
3 seconds is basically instant in the financial world.
Pretty much, yeah.
And it boasts asynchronous Byzantine fault tolerance, or ABFT, which, the reports say that is essentially the highest theoretical grade of security a distributed ledger can achieve.
It is. It protects the system against massive coordinated attacks or even localized network outages.
Plus, it operates as a carbon negative network, which for traditional finance, that checks a massive compliance box for corporate ESG requirements,
Oh, absolutely. Those technical specs are impressive. But the feature that truly wins over corporate risk departments is the fee structure.
The predictable fees.
Right. On a network like Ethereum, transaction fees fluctuate wildly based on network congestion.
Yeah, one day it's cheap, the next day it's astronomical.
Exactly. And if you are a global supply chain company, you simply cannot budget for a tracking system where a database entry might cost, 2 cents today and $40 tomorrow.
You'd be laughed out of the boardroom.
Right. So Hedera solved this by permanently pegging its transaction fees to the US dollar, starting at just a fraction of a cent.
Like $0.0001 to be exact.
Exactly. You pay that fee using the HBAR token, but the fundamental cost in dollars remains perfectly predictable regardless of what the token's market price is doing.
Which is just brilliant for an annual corporate IT budget.
Yeah.
But okay, here is where we have to talk about the governance, because this is easily the most polarizing aspect of Hedera across our entire research stack.
Oh, definitely. The governing council.
Yes, the Hedera Governing Council. We are talking about up to 39 term-limited global organizations. Like we mentioned Google and Boeing, but there's also Dell, Deutsche Telekom, and more recently, McLaren Racing.
It's quite a roster.
It is. But I have to push back here. You look at this structure, and it looks exactly like a Fortune 500 board of directors just ported over to a crypto network.
Sure, it does.
So doesn't this highly corporate, invite-only structure completely defeat the entire permissionless, decentralized ethos of cryptocurrency? Like, isn't this just a centralized database with extra steps?
Well, it is the single most common critique from the broader market. I'll give you that. And it absolutely deters a large segment of crypto-native purists who demand, pure permissionless decentralization from day one.
Right. They see those corporate logos and just immediately walk away.
They do. But looking at it from the perspective of an institutional allocator, this so-called centralization is actually branded as a governance advantage.
A feature, not a bug.
Exactly. It is the precise feature that risk-averse institutions are shopping for.
Because that desire for boardroom predictability is exactly why these institutions care so much about who is at the wheel. I mean, you can't have a Fortune 500 company building billion-dollar infrastructure on a token if a rogue group of anonymous developers might just dramatically alter the code next week.
Exactly. They need absolute stability. They need a legal guarantee that the network won't suddenly experience a hard fork.
Right, which is when a blockchain community disagrees and just splits into two competing networks, duplicating all the smart contracts and tokenized assets along with it. A total nightmare for a bank.
A complete nightmare. So the Governing Council provides legal, operational, and technical predictability. It is a calculated trade-off.
You're sacrificing ideological decentralization for commercial reliability.
Bingo. For a major commercial bank or a global airline, they will choose the corporate governance model every single time.
And that corporate governance model leads directly into the biggest hurdle for getting any digital asset into a traditional portfolio, right?
Yeah.
Regulatory compliance.
Oh, the giant elephant in the room.
Exactly. For years, the crypto space has been shadowed by the SEC, with this constant looming threat that these tokens might be classified as unregistered securities.
And it has been a dark cloud that successfully kept, frankly, trillions of dollars of traditional capital just parked on the sidelines.
Yeah.
If an asset is an unregistered security, an institutional fund simply cannot touch it without facing catastrophic legal liability.
But the market reports from our stack highlight a massive fundamental shift here.
Yeah.
In March of 2026, there was a joint interpretative guidance from the SEC and the CFTC that officially classified HBAR, along with XRP, as a digital commodity.
Which is huge.
Yeah, this effectively shields it from securities laws entirely. That is a colossal regulatory overhang completely lifted off the asset.
It really is a watershed moment for the network. It formally establishes that HBR's value is derived from its network utility and open market demand rather than, an expectation of profit based on a central managerial team.
Right. And when you combine that newfound regulatory clarity with the comfort of the governing council, you suddenly have an asset that comfortably clears the most rigorous compliance hurdles for major funds.
And the traditional market clearly agreed because we immediately saw the launch of new financial infrastructure following that.
Oh, right, the ETFs.
Yeah. The Canary HBAR ETF started trading under the ticker HBR on the NASDAQ back in October 2025.
And by July 2026, the reports show it holds over $50 million in net assets. That equates to about 549 million HBAR, or roughly 1.3% of the entire circulating supply, locked up inside a regulated ETF vehicle.
Which is no small feat.
No. And we also saw Hedera fully integrate with Utila for institutional-grade custody, which just smooths the runway even more for big money allocators who need secure vaulting.
But the most fascinating detail regarding that Canary ETF emerged a bit later, in June 2026.
Oh, the staking thing.
Yes. Canary Capital actually amended the ETF's trust agreement to allow them to take the HBAR holdings and physically stake them to the Hedera network.
Yeah, and the fine print on that staking amendment is just wild to me. The yield generated from that staking goes to the sponsor, right? Canary Capital, as their compensation.
Correct.
It does not go to the shareholders holding the ETF. So as an ETF buyer, it's like renting out your house. But the property manager gets to keep 100% of the monthly rent money.
Right.
Like, why in the world would an investor want that deal?
It sounds like a completely terrible deal for the homeowner. On paper, I totally agree. But you have to look at the macroeconomic effect on the token itself.
Okay, what do you?
The institutional logic here is entirely focused on the overall property value, creating what economists call a supply sink.
Oh, so they are essentially acting like a giant sponge, locking up tokens inside these staking contracts to squeeze the liquid market and prevent them from being sold.
That is the exact mechanism at play, yeah. Even though the ETF shareholders are not collecting that specific daily staking yield, the ETF is physically locking up over $500 million HBAR in non-circulating staking contracts just to secure the network.
Wow. So that massively reduces the active sell-side pressure on the open market.
Exactly. For an institutional investor holding the ETF, the thesis is that by locking up so much active supply, the sponsor is helping to build a much healthier, scarcer foundation for the underlying spot price of the asset to appreciate.
I see. So they are happily trading the yield for the capital appreciation of the core asset.
Exactly.
But, okay, here's where it gets really interesting, though. We just laid out a pretty incredible institutional setup. You have underlying technology that runs circles around legacy chains.
Yeah.
You have a board of directors featuring global industrial titans. You have official bulletproof regulatory clarity as a digital commodity. You even have an active Wall Street ETF literally eating up supply.
Sounds perfect.
Right. So if everything is so structurally perfect, why is HBR hovering around 7 cents in July 2026? That is over 86% below its 2021 all-time high of 57 cents.
Yeah.
It just feels like a total disconnect between network success and token price.
It is. And this brings us to the core of the institutional dilemma. It's often referred to as the value capture paradox.
Okay, the value capture paradox.
Yeah, and this is really the central bear argument against HBR as a purely financial asset.
Well, let's dig into the actual network numbers from the CoinStats AI report, because they are huge. The Hedera network has processed over 71 billion total transactions. In Q3 of 2025 alone, it grew 386% year over year.
The growth is undeniable.
Right. There is massive, mathematically verifiable corporate usage happening every single second. But it just hasn't translated to token demand. Because
of the very feature we praised a few minutes ago, the incredibly low fixed US dollar transaction fees.
It reminds me of an incredibly successful toll road.
Oh, I like that. Go on.
Imagine a sprawling global highway that handles millions of corporate trucks every single day without a single traffic jam. But the toll is permanently set at a fraction of a penny. So the road generates just enough to easily pay for its own maintenance and server costs. But the shareholders who funded the construction of the road never see a meaningful dividend. How can the token price ever go up if the entire network is explicitly designed to be as cheap as possible for the users?
The toll road is the perfect metaphor for Hedera. I mean, the network deliberately prioritizes frictionless enterprise adoption over revenue capture for the token holders.
Why? They want people to use it.
Exactly. If you look at Ethereum, it operates with a dynamic fee market. When Ethereum gets busy, it has a mechanism that actually burns ETH, like permanently destroying it and removing it from supply.
Which creates scarcity.
Right. But Hedera does not do that. Its value accrual is entirely indirect.
So because the fees are a fraction of a cent, the sheer transaction volume has to be astronomically high to generate enough buying pressure on the open market to actually move the needle on the price.
Yes. And while token holders are patiently waiting for that astronomical volume to arrive, they are fighting a massive uphill battle against dilution.
Oh, the token unlocks. Yeah, if you're looking at your portfolio right now, you might be wondering why you should care about a treasury release in Q3 of 2026. But the sources point out a serious supply overhang.
It's significant.
Yeah, out of the 50 billion maximum supply hard cap, about 43.5 billion are currently circulating. But there are still huge tranches of grants being moved around. Like in February 2025, 3.5 billion HBAR was transferred to the Hedera Foundation to fund ecosystem development.
Right.
And there is a projected $268 million treasury release happening in Q3 of 2026. I mean, this acts as continuous, suffocating downward pressure on the price.
It acts as a structural ceiling. I mean, whenever the price does start to gain positive momentum from a news announcement, these pre-planned treasury unlocks or foundation grants can just introduce a flood of new supply to the market.
Just instantly suppressing the rally.
Exactly. It forces the asset to behave like a high beta, sentiment-driven token rather than the fundamental compounder that institutional allocators typically look for.
And we can't ignore the broader crypto ecosystem either, right?
Yeah.
If you look at decentralized finance or DeFi, Hedera is remarkably tiny.
Very true.
The total value locked, or TVL, which is basically a measure of how much actual capital users have deposited and left inside a network's financial apps, is hovering somewhere between 60 million and 150 million on Hedera.
Which sounds like a lot until you compare it to the rest of the market.
Right. You compare that to Ethereum with over 50 billion locked up, or Solana with over 8 billion. I mean, Hedera's DeFi presence is basically a rounding error.
It really is.
They completely lack the retail speculation, the meme coin casinos, and the massive DeFi liquidity that drives those reflexive parabolic price actions on other chains.
And this is a major calculated risk for institutional allocators. They clearly see the massive enterprise partnerships in the technology, but they also see an asset that repeatedly fails to hold on to its rallies.
Because it lacks that organic retail-driven liquidity and DeFi stickiness.
Exactly. The network itself is undeniably thriving, but the token holder often feels left holding the bag.
Okay, so if the current tokenomics are acting as a massive headwind, what is the actual bull case? Why do analysts believe this is still a viable portfolio asset for the remainder of the decade? I guess we have to look at the 2030 outlook.
We do. The bull case hinges entirely on a very specific industrial transition, moving from proof-of-concept enterprise pilots into full-scale mission-critical production.
Right.
And the technical roadmap laid out in the reports actively reflects this push.
Yeah, the sources highlight some major technical leaps meant to attract that scale. Mainnet v0.74 successfully pushed Fortune 500 supply chain solutions onto the live public network.
Huge step.
And they've also introduced full EVM compatibility, meaning developers can write smart contracts for Hedera using the exact same programming tools they already use for Ethereum.
Which removes a massive friction point for adoption.
Totally. But the biggest structural move by far is Project Hyro. They are literally donating the core Hashgraph codebase to the Linux Foundation for neutral open source governance.
Which is just a masterstroke. Donating the code to the Linux Foundation is crucial for securing enterprise trust, primarily because it eliminates the fear of vendor lock-in.
Right, because if you are a global government or a company like Boeing, you simply won't build billion-dollar infrastructure on software owned by a single private crypto company.
Exactly, a private company that could theoretically go bankrupt or change the licensing terms on a whim.
You can't take that risk.
You can't. So by giving the core architecture to the Linux Foundation, Hedera guarantees the code will survive indefinitely as a public open standard.
Kind of much like the core architecture of the internet itself.
Precisely. It proves to the world that Hedera isn't a closed proprietary walled garden, which is an absolute prerequisite for landing these massive government and Fortune 100 integrations.
And we are already seeing those integrations take root in the real-world asset, or RWA sector, which, for you listening, is the process of putting traditional financial assets like bonds or real estate onto a blockchain.
It's a massive growth area.
It is. Lloyd's Banking Group is actively using Hedera for tokenized foreign exchange collateral. The Stablecoin Studio is driving central bank digital currency pilots around the world. But, how does this enterprise traction translate to actual price predictions? Because the financial models from our sources are just all over the place.
Oh, they reflect a very deep ideological divide in how analysts value raw utility versus retail speculation.
Right. You have Wallet Investor, which is deeply bearish. They project the price will actually fall to around 5.5 cents long term.
Which is grim.
Yeah. They are basically betting that the continuous token dilution will easily outpace any fee pressure generated by enterprise growth. But then you have the moderate models like KuCoin and Digital Coin Price.
And what are they saying?
They target anywhere from 18 to 55 cents by 2030. That is based on the assumption that these massive enterprise pilots go fully live, generating slow but steady compounding fee pressure.
That feels reasonable.
But then you have the highly speculative bullish models like Coinpedia targeting $1 or more.
Yeah, and we have to inject some heavy mathematical realism into that $1 target.
Right, because for HBR to hit $1, it needs to capture a market cap of over $43 billion. I mean, isn't it fighting a losing battle, trying to catch up to Ethereum and Solana's overwhelming network effects and developer mindshare?
It seems like it, yeah.
It's like Solana has millions of daily active addresses. Hedera has tens of thousands.
It's a stark contrast, but this raises an important question about how we are defining the competitive battlefield. Hedera isn't trying to beat Ethereum at retail decentralized finance.
Okay.
And it is not trying to beat Solana at trading meme coins. It is playing an entirely different game. Hedera is trying to win the boring but highly lucrative enterprise backend.
Oh, like the unseen infrastructure of global commerce.
Exactly. Think about Avery Dennison's @ame.io platform, which is currently tracking billions of physical items through global supply chains directly on Hedera.
Billions.
Billions. Think about auditable ESG reporting for multinational corporations, or regulated financial institutions settling tokenized real-world assets.
So they don't need retail users, they need corporate volume.
Right. Hedera is betting that the sheer volume of these automated enterprise transactions will eventually dwarf the volume of human retail crypto trading.
Wow.
If they manage to capture the back-end plumbing of global commerce, a $43 billion market cap doesn't seem quite so outlandish by the end of the decade.
It's the classic tortoise and the hare scenario. They are intentionally ignoring the retail hype cycles to build the foundational plumbing for the Fortune 500.
Precisely.
So what does this all mean for you trying to construct a resilient institutional portfolio today?
Well, it means HBR requires a very specific, very disciplined allocation strategy.
Right. If you are building that portfolio, HBAR represents a moderately attractive but distinctly high-risk diversification play.
It is not a core holding.
No, it is best suited as a long-term option. Think a 3 to 5 year horizon for portfolios that are already heavily weighted in highly liquid dominant layer ones like Bitcoin and Ethereum.
Right.
You buy HBAR specifically to gain targeted asymmetric exposure to the enterprise real-world asset tokenization theme.
Because HBAR has officially transitioned from a speculative retail asset into a utility-backed digital commodity.
Yeah.
And the ultimate test for this investment thesis over the next few years really comes down to simple math. Can the velocity and sheer volume of enterprise network usage eventually outpace the continuous supply dilution from the Treasury unlocks?
If it can, the upside is substantial.
But if it cannot, it will remain a technically brilliant, highly utilized network with a frustratingly stagnant token.
Which leaves us with a fascinating philosophical question to mull over as the digital asset space matures. I mean, if a network successfully settles trillions of dollars in corporate value, tracks the entire global supply chain, and secures bank collateral, but only costs pennies to operate, are we evaluating its worth with the wrong financial metrics entirely?
It's a great question.
Maybe the future of blockchain value isn't found in extracting exorbitant fees from users, but in becoming